educate traders and investors with strategies and educational videos. If you are liking our videos, kindly subscribe, share, like, comment, and hit the bell notification so that you can be notified when videos are posted on real time. In today's video, we will try to understand a very interesting strategy called the traffic light strategy, its setup and rules for trading or scalping. Let's understand who can use this strategy and when. This strategy is useful for scalpers, intraday traders, positional traders and office goers. There are no indicators or technical analysis required for this setup, and any trader from beginner to pro can use this and churn out 500 to 1000 rupees profit depending on his or her expertise and risk appetite. Here are the rules for this strategy. Kindly note these down and practice the setup on paper so that you understand when to apply these rules and how to enter and come out of your trade conveniently. Rule number 1. The time frame for scalping should be 1 minute. Here in this setup, skip the first candle at 9:15 since there will be volatility. Rule number 2. The time frame for intraday trading should be 5 minutes and above, and all candles should be considered. Rule number 3. You can trade positionally with this setup. The time frame should be 15 minutes and above as per your convenience. Rule number 4. Stop losses should be strictly defined. Should not be more than 50 to 70 points. If 2 stop losses are triggered consecutively, shut down your terminal and analyze your trades and come back the next day. Rule number 5. Risk to reward ratio to be determined before taking any trade. If in profit, stop losses to be trailed accordingly. Rule number 6. Choose in the money or at the money strike prices where the premium is in the range of 150 to 250 points. Rule number 7. Do not be emotionally attached to your trades. Do not take contra trades. Rule number 8. This strategy is efficient when the market is trending upwards or downwards. The strategy is very simple. You would have to look for a pair of green and red candles consecutively in any order. Mark their high and low and trade the direction it breaks. Take call options when the market breaks upwards and take put options when market breaks from the low of the candle. The risk to reward should be 1:2 and should be trailed in case profits are more than that in trending markets. Let's take an example so that we can understand the strategy. Here we have taken the Nifty in the money strike price of 18,600 and marked the high and low of the red and green candles. The market was more or less sideways and choppy. However, for most part of the day, the trend was down, and hence the strategy should have been to take puts of 18,600, the 8th of June strike price, as it was in the money or at the money range. The entry premium would have been 58, stop loss at 53, and first target would have been 72 and second target would have been 89. So the risk to reward was 1:2, which should be considered good for a choppy day. Similarly, calls could have been taken after 2 p.m. for a 15 to 20 point gain. Considering the lot size of Nifty, it would have yielded 1000 rupees on either side. Disclaimer: trading involves risk of losing capital, and hence it should be used after backtesting and certainly with other indicators. Please exercise caution since this is not a recommendation but an educational video for users to backtest and then modify according to one's need.